Hi everyone, welcome to the Diamond Finance channel. Today we are diving into the hot topic of gold investing in 2025 and we'll cover a few key points. Here are the highlights. First, gold prices have smashed through all-time highs with an incredible surge. Second, why isn't investing legend Warren Buffett a fan of gold? Third, what do other big-name investors like Ray Dalio and Harry Browne think about gold? Fourth, what's the relationship between gold prices and money supply? And finally, buying gold on its own can be super volatile. So, how can we reduce risk through portfolio investing? Let's grab a cup of tea and chat about all things gold investing in a chill way. First up, let's talk about the jaw-dropping rise in gold prices. On April 22, 2025, gold price hit a record high, reaching $3,505.9 per ounce, from its low of $1,618.3 per ounce on November 3, 2022. That's a jump of 117% in less than 2.5 years, more than doubling. That's absolutely wild. So, what's driving this surge? There are a few key factors. First, central banks around the world are on a gold buying spree. In 2024, global central banks bought a net total of over 1,450 tons of gold, set a new record. Next, geopolitical tensions are heating up. Things like the Russia-Ukraine conflict and the Middle East unrest are boosting demand for safe haven assets. Then, there is the expectation of a weak US dollar. The market thinks the Fed might keep cutting rates in 2025, pushing pressure on the dollar index. And finally, worries about inflation and currency devaluation. With global debt levels sky high, investors are flocking to gold. Major investment banks have also raised their gold price forecasts. Goldman Sachs even said gold could reasonably hit $4,500 per ounce. In April 2025, Goldman Sachs predicted gold might reach $3,700 per ounce by the end of 2025, and in extreme scenario, it could even touch $4,500. That is a pretty mind-blowing prediction. So, what do the big shorts in the investing world think about gold? And is gold a good fit for retail investors like us? Let's keep going and find out. Here is the next part. Second point. Why doesn't Warren Buffett believe in gold? Warren Buffett, often called the oracle of investing, had a super clear stance on gold. He doesn't see it as a good long-term investment. Back in 2011, in his famous letter to Berkshire Hathaway shareholders, he laid out his classic argument saying, If you took all the gold ever mined in the world and melted it into a cube, that cube would have size about 68 feet long. At the price back then, around $1,800 per ounce. That cube would be worth about $9.6 trillion. With that money, you could buy all the farmland in the US, which is about 400 million acres, plus around 16 ExxonMobils, one of the biggest companies by market value at the time. And guess what? You'd still have about $1 trillion left in cash. Now, fast forward 100 years, that gold cube, it would still be sitting there, unchanged. It doesn't produce anything. Meanwhile, the farmland would have produced tons of food, and ExxonMobil would have paid out huge dividends. So, Buffett's gold idea is gold is a non-productive asset. It isn't like stocks, farmland, or real estate that can generate cash flow or dividends. He once bluntly said, gold just sits in a coffer, hoping someone will pay a higher price for it. In Buffett's view, investing should focus on assets that create long-term value. Gold clearly doesn't fit his investment philosophy. So, what do other investing legends think about gold? While Buffett isn't a fan, other big-name investors actually love gold. Let's check out the views of two famous portfolio gurus. First up, Ray Dalio. He said gold is the cornerstone of diversification. Ray Dalio, the founder of Bridgewater Associates, is a big supporter of gold. He thinks gold is especially important in certain situations. When currencies are losing value, when central banks print too much money and the purchasing power drops, gold can effectively hold its value. Also, in terms of geopolitical risk, gold is a fantastic tool to hedge against uncertainty. So Dalio suggests investors allocate 5% to 10% of their portfolio to gold. In his famous all-weather portfolio, gold makes up 7.5% of the mix. This portfolio, by spreading out assets, reduces volatility and performs steadily over the long term. Dalio once said, gold isn't a high-return asset, but it's a key part of a balanced portfolio, especially in low-interest rate and currency devaluation environments. Next, let's look at Harry Browne's take. He says gold is the ultimate safe haven asset. Harry Browne, the creator of the permanent portfolio, believes gold is invaluable in extreme situations like a currency crisis or global economic turmoil. It is an irreplaceable safe haven asset. He once said, in a global currency crisis or dollar crisis, no one can control gold prices because too many people will be scrambling to buy it. That's why in the permanent portfolio, gold takes up a whopping 25%, This portfolio is designed to handle all kinds of economic conditions, like booms, inflation, recessions, deflation. Let's look at some historical data. From 1972 to 2003, the permanent portfolio had an annualized return of 9.5%, with much lower volatility than a pure stock portfolio. Also, gold rarely shined in the 1970s, when inflation was sky high, and in the early 2000s. During economic downturns, proving its value as a safe haven by delivering key returns to the portfolio. Next, let's talk about the core driver of gold prices, its relationship with money supply. The long-term trend of gold prices is always closely tied to money supply. Simply put, when central banks print too much money and the currency's purchasing power drops, investors turn to gold to preserve value. Let's look at two historical examples. First, in the 1970s, when the US abandoned the gold standard, in 1971, after the dollar was decoupled from gold, the Fed massively increased the money supply and inflation soared. Gold prices shot up from $35 per ounce in 1971 to $850 per ounce by 1980, a staggering 2,300% increase. Then, after the 2008 financial crisis, the Fed rolled out quantitative easing policies, and the money supply surged. During this time, gold prices climbed from a low of about $800 per ounce in 2008 to $1,900 per ounce in 2011, a 138% rise. Now, since 2024, the global central bank gold buying spree, which hit 1,045 tons, along with expectations of a weak dollar, has pushed gold prices even higher. The current US M2 money supply as of March 2025 is about $21.2 trillion, up roughly 30% since 2020. This provides long-term support for gold price increases. Moving on, let's talk about some gold investment tips. Specifically, using portfolio investing to reduce volatility. We can see that gold's long-term trend is clearly upward, and its value-preserving role really stands out during currency devaluation and geopolitical turmoil. But gold prices can be pretty volatile, and just buying gold on its own definitely comes with some risks. So, looking at the charts, we can see the historical maximum drawdown from 1980 to 2008. Gold went through a 28-year stagnant period, with a maximum drawdown of 70.26%. From 1968 to 2025, its annualized return was 8.14%. And from the charts, we can also see its short long-term uncertainty. In the short term, its ups and downs are hard to predict, influenced by macroeconomic factors, interest rates, geopolitics, and more. So, Diamond Finance recommends treating gold as a part of your portfolio with a long-term holding strategy and using portfolio investing to lower volatility. Here are two classical portfolio strategies we recommend for gold allocation. First, Harry Browne's permanent portfolio with gold making up 25%. From 1972 to 2003, it had an annualized return of 9.5%, with a maximum drawdown of about 20% and a much lower volatility than a pure gold portfolio. Next, there is Dalio's all-weather portfolio, where gold takes up 7.5%. Its long-term annualized return is around 7%, with a pretty low maximum drawdown, making it great for investors who prefer stability. For investors looking for stability, here is another example: a 50% S&P 500 and 50% gold portfolio. We back-tested historical data from 1968 to 2025, and here's what we found. Its annualized return was 10.41%, compared to 8.14% for gold alone. Its maximum drawdown was 38.62%, compared to gold's 70.26%, a lot lower, right? It basically cuts the drawdown in half, doesn't it? Thanks for watching this episode of Diamond Finance. If you found it helpful, don't forget to like, subscribe, and share.